This is a tax break that real estate investors love using. It says you deserve a tax break because your property is 1 year older, even if your property is making you more money, and even if your property has gone up in value. Take a look. Let's assume that you're a real estate investor and you find this property on sale. You buy it for $250,000. Now, just for the sake of accounting, let's assume that out of this $250,000 that you paid to buy this rental property, $50,000 is the value of the land and $200,000 is the value of the property, but you paid $250,000 to buy the land and the building. Now you buy this property and you rent it out. You rent it out for $2,000 a month, which means you're making $24,000 a year in rental income. But now you have to pay for your expenses, your property taxes, your insurance, your maintenance fees, your management fees, and your vacancy costs. So let's assume that you have $14,000 a year in expenses, which means you have a net income of $10,000. Now normally, if you make $10,000, you have $10,000 in your bank account, you have to pay taxes on all $10,000. But in real estate, remember what I just said, you have this depreciation deduction, which says because your property is 1 year older, you deserve a write-off. Now, what it says, the IRS, is if this property is a single family home, which that's what this picture is, you take the value of the property, the $250,000 you paid for the land and the building, subtract the value of the land, which is $50,000. So you take the $200,000, the value of the property, and you divide that by 27.5. This is what the IRS says when you have a single family property. If it's a commercial building, an apartment complex, an office building, then you use 39. So this tells me that according to the IRS, you deserve about a $7,200 write-off a year just because your property is 1 year older. Why? Because that's what the tax code says. This is the depreciation deduction. Your property is 1 year older. You deserve a tax break. So now, you have $10,000 in the bank. You made $10,000 of profit, but you're not gonna pay taxes on $10,000. So you're gonna say, hey IRS, I made 10 grand, but according to this depreciation deduction that you gave me, I should subtract $7,200 from my taxable income, which means in reality, my taxable income is $2,800. This is the money that you're gonna pay taxes on, not the $10,000, which means you get to make money and pay less in taxes because, well, you get these tax breaks. And this is where things can start to get a little bit more advanced, which brings me to tax break number 4, accelerated depreciation. Now this is gonna get a little bit technical, but if you stick with me, I promise I'm gonna do everything I can to help it make sense. This is called straight line depreciation, because you're taking the same depreciation amount every year for the next 27.5 years. So this year, you deduct $7,200 from your taxable income. Next year's the same, next year's the same, next year's the same. You do that for 27.5 years. But there's an alternative that the IRS gives you, and it's called accelerated depreciation. And what that says is you get to take a bigger tax break in the beginning. That way you can take a bigger write-off right now. So let me erase the $7,200 write-off and let's do it again with accelerated depreciation. Same situation as last time. You bought this property for $250,000. $50,000 is the value of the land, $200,000 is the value of the building. You rent it out for $2,000 a month, that's $24,000 a year. You have $14,000 a year in expenses. Nothing has changed. You have $10,000 of net operating income, $10,000 of profit. Normally you have to pay taxes on all $10,000, but you have a very smart accountant who says you should do something called a cost segregation study. And now what you can do is accelerated depreciation. You're not going to take this regular $7,200 depreciation in year one. Instead, you're going to do a much bigger depreciation because this is what your accountant can do. They can look at different things in your building, in your property, and say, instead, we're going to take a $35,000 depreciation in year one. This is called accelerated depreciation because you're taking more of that total depreciation amount in the early years, which means you made $10,000, but now you have a $25,000 loss on paper. Remember, you have $10,000 in your bank account. You just tell the IRS, I lost $25,000, which means your taxes on this $10,000 of profit is zero because your taxable income is negative $25,000. But this is where now things can get fun, because what happens if you have a job? This is you. Over here, for my male followers, I'm going to draw a mustache, which in my native language Punjabi we call a much. And for my female followers, I'm going to draw your braid again, which in my native language Punjabi we call a gut. You are making, let's call it $100,000 a year from your job. And this is supposed to supplement your job income. Now, when you make this $100,000 a year from your job, remember, you have to pay taxes on this income, but you have this loss. Could you take this loss and subtract it against this income? And the answer is maybe. If you make $100,000 a year or less, you can deduct up to a $25,000 loss against your income, which means in this situation, you're making $100,000 a year. You have the $25,000 loss from your properties. Now you pay taxes on only $75,000. Remember, you made the $100,000 from your job, you made $10,000 from your property, you're not going to pay $0 in taxes on this because of your depreciation. And then this depreciation is going to carry over to your job income. That way you can also lower how much money you're going to pay in taxes. So you're only going to pay taxes on $75,000 of your job income. So not only did you get to take away that taxes, but you also lowered these taxes. Now, if your income is over $100,000 a year, you won't be able to take this loss against your income. You'll have to carry this loss forward unless you fall into one of the IRS's exemptions. And you can start to see how a good accountant can be very valuable, because what the IRS says is normally if you make over 100 grand a year, you can't take this loss against your regular income. But if you are a real estate professional, meaning most of your time is spent actively taking care of your properties, actively working in real estate, well, now you can make over $100,000 a year and take this loss and deduct it against your active income. Now you might say, well, Jaspreet, I'm a data scientist. How am I supposed to do that? Well, if your spouse, your husband or wife, is a real estate professional, they're managing the rental properties, they're actively working there, and that's what they're doing most of their time, well, now you as a couple can qualify to take this loss against your active income. You can see again why it's so important to understand the tax codes, because it's not just working to earn more money, it's also understanding how you can keep more of the money in taxes legally. And the third option that you have is if you turn this property into a short-term rental, like an Airbnb, where the average rental is less than 7 days, well, now you can take this loss against your active income if this is a short-term rental as opposed to a long-term rental property. And now we can kick it up one more notch, which brings me to tax break number 5, the like-kind exchange. If I invest $1,000 in the stock market and my $1,000 turns into $5,000 and I sell my stocks, well, I have to pay taxes on that income. Even if I take all $5,000 and I buy a new stock, I'm going to still have to pay taxes on my $4,000 of profit. In real estate, you don't always have to. So let's go back to this example. I bought this property for $250,000. Yes, I rented it out, I'm making money, I'm getting these tax breaks. That's all great, but let's ignore all that for a second. Let's assume now 5 years go by. Yeah, I've been making money. Yeah, I've been getting these tax breaks, but now my property is not worth $250,000. I find out on Zillow that it's worth $500,000. Oh baby, my property doubled in value. Now I could sell my property and have this $250,000 gain. I got to pay taxes on that. Or I could do something different. I could do a 1031 exchange. And this 1031 exchange says I can take all $500,000 in proceeds from this sale, pay $0 in taxes today, go out and buy another property with all $500,000, make more money in rental income, and not have to worry at all about paying these capital gains taxes. And I can do that again and again and again until I die, assuming that I own the property for at least 1 year, because it's real estate, and real estate has some of the biggest and best tax breaks that a tax code has to offer. This is called the 1031 exchange. And the 1031 exchange allows you to compound your money, grow the values of your properties, sell your property for a big profit, pay $0 in taxes today, and take all the money, dump it into more properties that are going to pay you with even more cash flow. And now you don't have to worry about paying capital gains taxes or depreciation recapture taxes. And this is one of the ways that wealthy people are able to grow the value of their wealth tax-free, because when their properties go up in value, instead of selling it for a profit, they just take all that money and buy another property and keep letting the properties grow in value while getting these depreciation deductions. That way you can make money, pay less money in taxes, and then a few years later, you flip it and buy another property and do it again and again and again. This way you can compound the value of your wealth. Now, of course, there's a lot of nuances here. It takes work, it takes time, and if you're going to do a 1031 exchange, get a specialist. because there's a lot of rules, and if you do it wrong, you're going to be subject to a lot of taxes. And this is why real wealth isn't just about how much money you make, it's about how much money you get to keep, because if you can make the same amount of money and keep a lot more of it, well, now you can grow your wealth a whole lot faster. A good accountant can help, because you need to have good understanding of the tax code, because for wealthy people, the tax code is a rule book that you just got to learn the rules to, that way you can win in the game. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.